Hi everyone, let's talk about NETE Element. It's a financial technology company that provides payment acceptance and value-added solutions across the various channels in the North America, Russia, and the Commonwealth of Independent States. Market cap is currently 54 million. Snowflake analyzed on the financial health 406, future growth 106. Revenues forecasted to grow almost 10% per year. Earnings already grow by almost 30% per year over the past 5 years. Unfortunately, the company is unprofitable, not forecasted to become profitable the next 3 years. They also printed the shares out, I guess, a lot since actually 10 years ago it was 181,000. Currently it's 5.3 million stocks. That is diluting the shareholder equity, and which means that if it was, for example, 1 year frame 64%, 5 year frame minus 18, and max size minus 98%. So that tells something about the business. And also that based on simple Wall Street does not have meaningful market cap, which is 55 million. Latest share price and events, there was pretty much only the earnings updates that is making the market performance. 1 year return 51%. Yeah, as I told you, the bigger frames, three-year return is pretty much the same, almost 62%, but 5 year is already on the negative side, minus 25%. Long-term price volatility vs market on the highest point, so the beta is, I guess, more than 1. Valuation side, simple Wall Street does not have any price targets, neither the tip ranks. Actually, MarketWatch has the stock price average $30. So based on MarketWatch, they could made triple. So basically from the $10 that is currently to $30 per share. And I guess there is possibilities that it would bounce back to those numbers that it was, for example, December 30th, highest point 19. So it could easily bounce like to double, but there's a pretty risky that if they it depends if there would be good news for the company, it will affect definitely on the price. But we see that multiple bottom, if for example if the stock price continues to be in this tunnel. So we see here from the $13 to $9. So there's the tunnel. I guess it could mean that somebody of bigger sharks, as they say, loading this up. So this is actually very likely situation for the traders. When they see this one, they actually know that somebody is loading there from the 9 to 13. This is actually very good situation for the traders, because whenever the price go and almost hitting the 9, they are adding. Then once it bounces around 12, 13, they are selling it. Then they just play around. It's of course a risky situation, but those who are on a stock market longer, they know this kind of tunnel stuff. But the short term, we see this is downtrending, but definitely we'll be back on this checking that is there somebody loading this up, because yeah, actually in December the volume were at almost 50 million, 49 million, and currently almost 10 million. And the future growth for the company is forecasted annually, 146%. That's pretty huge. And earnings per share growth forecasted as well. They might become actually profitable in the next year, so I'm not sure where this comes from. Currently it's unprofitable, not forecasted to become profitable. So that's actually one of the mysteries, because here is said end of December 2022, EPS on the positive side, but yeah, never knows. Past performance, historical annual earning growth increased 27%. This dynamic is pretty good, so they managed to increase the earnings. For example, September 2014 earnings minus 28. The revenue were 21 million. Currently, there's almost 100 million in the revenue, and earnings are increased to minus 2.6 million. So I guess this is moving to the positive side. But of course, currently the company is unprofitable. On the financial health side, we see that they have a lot of debt and not so much cash. So the debt almost 9 million, equity 6 million, and cash 3.9, so basically 4 million. Debt to equity ratio is currently 145%, which is very high. Balance sheet looks mostly green, but actually, yeah, this is combined. There's a red dot there. They're not paying dividends, and let's skip the management side to the insider transactions. No volumes. Ownership breakdown, general public holding 72%, insiders almost 15, institutions 13. Top shareholders. So let's check this out. So Vanguard, no change. BlackRock did not increase. Last reporting holding date in the June, and I guess the Vanguard is same. Yeah, that's interesting because there's on both side, and some of the so this is interesting. Chief Financial Officer decreased 82%, and independent director and also other one increased pretty significantly, 700 and 500%. Citigroup decreased 83%. Morgan Stanley increased 100%. That's pretty interesting. But anyway, as I said, the shares outstanding keep increasing, and total sales are increasing as well, by the way. This is a very good situation for the company. That's not bad. So if it would be on the other side, the shares outstanding would be increasing and total sales would be increasing, that would be pretty ideal situation. And if they could be, for example, return on equity positive, return on invested capital would be positive. It could be a lot costed the share price would be a lot more. Somewhere around these numbers, so $500 per share. And investing.com summing the stock for long-term investors as a neutral by moving average. Sell, technical indicators neutral. Let's check the comments. So January, back up the Brinks track, please. Mike, what's going on? My brothers for long. Mid-grade, my friend. Hope we make good money with it. That was in January. So the price went. So this is actually the after this one. So it hit. If we open the 1 year frame, so those who, actually it begins like from scratch. The price pumped 144% within 1 month. That is, of course, putting the stock on the trend list, and looks like good company with 2 or 3 years perspective. I think is similar to Square, and it grows fast. My friend, I didn't even know they're making EV as well and have huge range over 1000 kilometers. If Square is successful, they can be too. Yeah, actually, these kind of small cap companies are, and also I didn't mention the chief executive officer, also the executive chairman and CEO, adding 32%. I'm not sure why it's not here on the insider list, but it's here. July 16th, last reporting holding date. So basically last month. So yeah, my point is there some of the investors, also traders, try to figure out and also find this kind of small cap companies. For example, this one, 554 million in the market cap. And actually, if we see here that the price went, yeah, 500, for example, dollars, but yeah, actually it's not. It's not the same because they had less stocks. So if we need to calculate the market cap, we need to do simple math by adding the shares outstanding and also the price of the average price of the year, and then we will get the market cap. But this one, if they will continue to the revenue, I think I guess they have pretty huge potential, because it's the annual earning growth is forecasted over 146%. That's pretty huge. But many of you have been commenting the drops and the pump and dump stocks. So basically my point of it, you just open the maps, you see the S&P 500 here on the corner, and for example the 1-year performance. So mostly there's a green. I'm not talking about the correction that might be somewhere around future. This is the stocks that if you're not willing to buy, for example, the ETF or some of the other funds that might cost a lot. So the entering point would be 1%, exit point 1%, and also the premium for the fund would be around 1%. So that's huge. There is low cost funds, ETF funds, that is with zero commission, but I guess the premium is from the positive return. It could reach to the 20%. So mostly you avoid the pump and dump stocks by investing in this kind of companies from the S&P 500 list, and you can diversify your portfolio by industry. So you see here the technology sector, there's communication services, there's consumer size, consumer, actually internet retailer, cyclical consumer products, and consumer defense, Walmart, Costco, and these are pretty much the dividend stocks also. So whenever you are growing, whenever your strategy is to find the growing stocks or the dividend stocks, it doesn't matter. You can diversify by industry, not looking does the company pay dividends or not. Usually those companies who are paying dividends, they have lower PE ratio, and they increases the dividends, so it's not so bad. And on the other side, there's a Facebook, for example, which is not paying dividends. Google also, Amazon, Microsoft, I guess they pay. Apple pays. Visa is a financial sector, and pick at least 10 stocks from this list, and of course diversified by the industry. And then you can diversify by time. So by buying some of the stocks, for example, if you have 10 grand, you invested already, after 1 month they could be negative return. So for example, you brought the telecom communication services, and you look at the, for example, Verizon, you have almost minus 7.6, and you have on the other side, for example, Google, which grow pretty significantly, 76%. What you need to do is look at the proportions. If you have 10 stocks, that will mean that $1,000 per each category. So per each company you invested 1,000. After 1 month, for example, it doesn't necessarily need to be this kind of numbers, but for example, if it grew 76% within 1 month, and Verizon, for example, decreased by 7%, you need to calculate how much you need to add Verizon that it could the price could reach same of the Google's price. So Google's would be worth $1,760. So they almost double it. But since this decreased, you would have around 900, for example, $50. And you have to add, then you're buying till it's same as the, for example, top one. Of course, the other proportions would be not clear, so you're just adding, and all the time diversifying the portfolio. Because once other company that have been making a lot of returns, 100% or more, it could do the correction, so it might go down. And as it goes down, there's high possibilities that the dividend stock that you had that making the negative return could bounce to the same numbers that not actually so fast grow, but actually they are in the defense category because of the lower P ratio. If you have something to ask about this diversifying thing, I could make a different video of it, but I hope this clears the strategy. For example, my strategy is this one. I don't recommend to trade because there's statistic that those who trade, 95% of the traders at some point lose their money. That's unfortunate. So not on this cycle, especially when the S&P 500 is growing, but on the crisis. So the traders are more likely to deep in on the crisis. That's why I don't recommend. There's a high possibilities for losing the money, and that's because of the emotions that people has. But anyway, thanks for watching this video. Subscribe to the channel, like the video, and see you in a future one.